If you are watching this, you are likely part of a unique demographic that I have spent the last 20 years advising. You are the global Indian success story. You have built substantial wealth, liquid assets likely exceeding $1 million, often across multiple jurisdictions. Hello everyone, welcome to EPK Capital. I am Kunal. Here we simplify wealth management and investments so you can build wealth for generations. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high-net-worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's get started now. Maybe you are a tech executive in Silicon Valley, a consultant in London, a business owner in Dubai, or a medical professional in Sydney. You have mastered the art of earning in hard currency. Yet, like most of my clients, you retain a deep financial umbilical cord connected to India. We often sit in boardrooms or on Zoom calls discussing alpha, beta, yield, and capitalization rates. We chase the highest returns in Indian real estate or pre-IPO opportunities. But there is a silent, relentless force that erodes wealth faster than any market correction or bad stock pick. That force is double taxation. It is the friction cost of being a global citizen. Imagine earning a 12% return on a prime commercial asset in Mumbai. The Indian government takes its share. Then, because of a lack of documentation or strategic structuring, the tax authority in your country of residence, be it the IRS in the US or HMRC in the UK, steps in and taxes that same income again. Your real, inflation-adjusted return might plummet to 6% or 7%. That is not just a tax issue, it is a failure of wealth preservation. Today, I am going to walk you through the Double Taxation Avoidance Agreement, or DTAA. I will dismantle the complexities, show you the specific traps for countries like the US, UK, and UAE, and give you a roadmap to stop the leaks in your portfolio. At EPK Capital, our mission is building wealth generations, and ensuring you don't overpay taxes is step 1. Let's start with the single greatest misconception I hear. Clients often tell me, but India and my country have a treaty. I am covered automatically. This is dangerously incorrect. The DTAA is a benefit that must be claimed. It is not a default setting. Here is the reality. If you earn interest in India, the bank is legally obligated to deduct tax deducted at source, or TDS, at the highest domestic rate, which is often 30% plus surcharges. However, under the treaty with countries like the US, UK, or Canada, that rate is often capped at just 10% to 15%. The difference? That is 15% of your income vanishing into thin air every single year. On a large portfolio, that is a massive loss. To unlock that lower rate, you need 2 digital keys. The first is the Tax Residency Certificate, or TRC. This is the gold standard of proof. It is a certificate issued by the government of your country of residence stating that you are a tax resident there. A driving license or a green card is not a TRC. You need the specific document from the IRS, HMRC, or your local tax authority. The second key is Form 10F. Historically, this was a simple paper self-declaration. But as of late 2023, the landscape has changed. Filing Form 10F electronically on the Indian Income Tax Portal is now mandatory. This has caused significant friction for NRIs who previously operated without a permanent account number, or PAN, or without an active online tax account. But let me be clear, getting your PAN and registering online is no longer optional. It is your entry ticket to the system. Without these 2 documents, you are effectively donating money to the taxman that you were legally entitled to keep. Now, let's go deeper. The rules aren't the same for everyone. Let's look at the specific corridors where you might be living. If you are in the United States, listen closely. The India's corridor is complex. While the DTAA protects your income, it offers very limited protection against the US estate tax. Many of my high net worth clients assume their Indian assets are safe from the IRS. They are not. If you are a US domiciled person, the US taxes your worldwide estate upon death. This includes your ancestral home in Delhi and your mutual funds in Mumbai. If you are a US citizen, the exemption is high. But if you are a non-citizen resident, the exemption can be as low as $60,000. Anything above that can be taxed at 40%. This is a wealth destroyer. At EPK Capital, we focus heavily on estate planning to ring-fence these assets because a simple treaty claim won't save you here. Also, for my US clients, avoid investing in Indian mutual funds without professional advice. The US can classify them as passive foreign investment companies or PFICs, which come with punitive tax rates. You are often better off with direct equity or portfolio management services. Next, let's talk about the United Kingdom. The UK has a unique advantage with the 1956 Estate Duty Treaty. Unlike the US, this treaty can offer significant protection from UK inheritance tax on assets located in India, provided you are domiciled in India. For a UK resident with substantial Indian assets, this can save millions in taxes. However, be aware that the UK is moving towards a residence-based system, potentially abolishing the non-dom regime. We are monitoring this closely, but for now, the treaty is a powerful tool if leveraged correctly. Now, to my clients in the UAE. For years, you enjoyed a tax-free status. But India has introduced the deemed residency rule. If you are an Indian citizen with Indian income exceeding 1.5 lakhs and you are not liable to tax in any other country, India can deem you a resident and tax your global income. Simply living in Dubai is not enough anymore. You need to prove you are a UAE tax resident. The good news is that recent changes allow you to get a tax residency certificate if you have a permanent home and spend just 90 days in the UAE. But you must have the paper trail, specifically the immigration report showing your entry and exit dates, to prove it. Let's move to Canada. Canada has a unique departure tax. If you decide to retire back to India, Canada treats it as if you sold all your global assets on the day you left. You are taxed on the paper gains. If your Indian portfolio appreciated while you were in Canada, you could face a massive tax bill upon departure, even if you haven't sold a single stock. Strategic planning is required years before you board that flight. So, knowing all this, where do NRIs go wrong? I see three major mistakes repeatedly. Mistake number 1 is the NRE is tax-free fallacy. You put money in an NRE fixed deposit because the bank promised you tax-free interest. And yes, it is tax-free in India. But in the USA, Canada, UK, or Australia, you are taxed on your worldwide income. That tax-free interest is fully taxable in your home country. Failing to report it is tax evasion, and with data exchange agreements like FATCA and CRS, the tax authorities will find out. Mistake number 2 is failing to claim the foreign tax credit. Let's say you sell a property in Bangalore. India deducts 20% tax. You then report this gain in the US, where the tax might be 25%. You are supposed to pay only the difference to the IRS. But you can only do that if you file Form 67 in India before filing your return. I have seen clients pay full tax in both countries simply because they missed this one form. Mistake number 3 is repatriation. You have sold your assets, paid your taxes, and now you want the money abroad. The RBI allows you to repatriate up to $8 million per financial year from your NRO account. But to do this, you need Form 15CA and 15CB. This requires a chartered accountant to certify that your taxes are paid. Timing matters here. The limit resets every 1st April. If you are moving $1.5 million, you can move $1 million in March and the remaining $500,000 in April, saving you from having funds stuck in India for a year. So, how do you execute this? Here is your action plan. First, audit your residency. Count your days. Are you under 120 days in India? Know your status definitively. Second, get your TRC. If you are in the US, file Form 8082 today. It takes time. If you are in the UAE, log into the FTA portal. Do not wait until the last minute. Third, ensure you have a PAN and access to the Indian tax portal so you can file Form 10F electronically. And finally, look at your portfolio through a tax lens. Are you holding pre-2017 shares that are grandfathered from capital gains? Are you holding mutual funds that the US IRS will penalize? Wealth management is not just about picking the right stock, it is about keeping what you earn. As an NRI, you have a distinct advantage. You can arbitrage opportunities between two of the world's great growth engines. But you also have a distinct burden. You must satisfy to taxmen. Double taxation is optional. With the right paperwork and the right advice, you can ensure your wealth serves you, not the state. At EPK Capital, we don't just invest, we structure. We look at your residency, your global liabilities, and your long-term goals to build a fortress around your wealth. Whether it is navigating the repatriation caps, setting up a trust to mitigate US estate tax, or simply ensuring your documentation is bulletproof, we have the experience to guide you. If you are managing significant assets and want to ensure you are not leaving money on the table, I invite you to reach out to us. Let's review your structure and ensure you are truly optimized. Thank you for your time. Let's build wealth for generations.